Imagine an entirely parallel $2 trillion banking system operating right under your nose.
Yeah, just completely hidden in plain sight.
Exactly. I mean, there are no tellers to greet you. There are no ATMs on the corner. You won't find those little drive-through windows with the pneumatic tubes.
Or none of the traditional retail banking infrastructure at all.
For the vast majority of its existence, this colossal financial machine has just been operating entirely in the shadows. It is largely shielded from the daily chaotic scrutiny of the public stock market.
And completely invisible to the average person walking down the street.
But it touches almost every single aspect of the broader economy. And, we previously explored the mechanics of this massive system in our original deep dive on the $2 trillion private credit panic.
Which was a fascinating look at how the foundation was poured.
It really was. But today we are looking at August 11th, 2026, and the plot has dramatically thickened.
To put it mildly.
Right. We are pulling out a stack of brand new mid-2026 data from the Wall Street Journal and Reuters and Bloomberg and Fitch Ratings. And looking at these documents, the landscape has fundamentally shifted.
The stress tests are no longer theoretical. They are happening right now.
So our mission today is to revisit this massive financial juggernaut. We need to track where the foundation is cracking and update our understanding of the market's current stress.
And uncover what is honestly a massive, almost unbelievable paradox buried in these reports.
Yeah, the paradox is wild. Because while everyday retail investors are currently panicking, like fighting tooth and nail to pull their money out of the system, the giant institutions are doing the exact opposite.
Right. The real titans of global capital are quietly pouring record-breaking billions back into it.
Okay, let's unpack this.
Yeah.
Because before we can truly grasp why this bizarre paradox is unfolding, or why the warning lights are flashing red across these Bloomberg terminals, we need to anchor ourselves in the mechanics.
We have to reestablish how this invisible bank was built in the first place.
Exactly. Like, why did $2 trillion migrate away from traditional finance and flow into this shadow system?
Well, the best place to start is with the definition itself, because the terminology often misleads people.
Yeah, private credit sounds pretty straightforward.
Right. When you hear private credit, the immediate assumption is that it is just a private loan, like a wealthy individual lending capital to a small business owner off the books.
Which sounds simple enough. Just a standard IOU.
But that completely undersells the scale and the sophistication of what we're talking about here.
Right.
Private credit isn't just a category of loans.
What is it then?
It is a comprehensive alternative architecture for originating and holding and valuing corporate risk. It is an ecosystem that exists entirely outside of traditional regulated bank balance sheets.
And entirely outside of the public corporate bond markets too, right?
Exactly. It is a parallel universe.
So to make that architecture tangible for you listening right now, let's imagine a specific scenario. Let's say I am the CEO of a successful mid-sized company. I own a regional chain of, say, 50 dental clinics spread across the American Midwest.
Right, so you are the quintessential middle market business. You have solid cash flow and physical assets and a proven business model.
Now I want to aggressively expand. I want to buy out a competitor and add 50 more clinics to my empire.
A big move.
Yeah. And I need $100 million in capital to execute that buyout. Historically, if I went to the public bond markets to raise that $100 million, the process would be agonizing.
It would be a monumental undertaking. You would have to hire an army of expensive investment bankers.
And the paperwork.
Oh, the paperwork is endless.
Yeah.
You would have to file massive, tedious, publicly available disclosures with the Securities and Exchange Commission, the SEC.
So my entire financial history becomes public.
Your financial history, your risks, your executive compensation, all of it becomes public knowledge. Anyone can read it.
And then I'd have to go on a grueling roadshow, right? Like flying to New York and Boston and London, practically begging mutual fund managers to buy my corporate debt.
All while being completely at the mercy of macroeconomic sentiment.
What do you mean by that?
Well, in the public markets, your cost of borrowing is dictated by the daily emotional panic of the stock market.
Oh, right. So if a terrible jobs report drops on a Tuesday,
or there is some geopolitical tension on a Wednesday, the bond market might suddenly demand a much higher interest rate for your debt by Thursday.
So my expansion plans could be totally derailed by events completely unrelated to my dental clinics.
Exactly. And that volatility is exactly why private credit became so attractive to a business owner like you. It offers the complete inverse of that public circus.
So instead of filing an S-1 with the SEC and flying around the world, what do I do?
You walk into a closed-door room with a single private credit fund manager in Manhattan. You sit at a table. You negotiate a bespoke, highly customized loan agreement.
Just the two of us.
Just the two of you. You get total certainty on the terms, an incredible speed of execution, and absolute privacy from your competitors.
Okay, so from the borrower's perspective, it makes total sense. I get speed and discretion. But why did the investors want this?
You have to look at the other side of the table. The investors were practically begging for this asset class to exist.
And that tracks directly back to the 2008 financial crisis.
Right. Fundamentally, yes. After the global financial crisis, regulators descended on the traditional banking sector.
Through frameworks like Dodd-Frank in the U.S. and Basel III internationally.
Right. Regulators effectively told traditional banks that they needed to hold significantly more capital in reserve against the risky loans they made.
So the banks became heavily regulated.
Highly scrutinized and extremely risk-averse, particularly when it came to lending to those middle-market businesses like your dental clinics.
The traditional banks basically vacated the space.
They did. But at the exact same time, central banks around the world slashed interest rates to zero to stimulate the post-2008 economy.
And that created a massive dilemma for institutional investors.
A huge dilemma. I mean, if you are a pension fund managing the retirement savings of teachers or firefighters, you have strict obligations.
You need to hit a certain number every year.
Exactly. You need to generate a specific yield, say 7 or 8% a year, to ensure you can actually pay out those retirement benefits for the next 50 years.
But with interest rates at zero, government mandates were paying basically nothing.
You were starved for yield. So private credit steps into the void left by the banks, offering those desperate pension funds high-yield loans.
And crucially, they were offering floating rate loans, not fixed rate loans.
That is a vital distinction. With a fixed rate loan, if inflation hits and central banks raise interest rates, the investor is trapped earning an old low rate.
They lose money in real terms.
Exactly. But with a floating rate loan, the interest rate the borrower pays is pegged to a benchmark.
So if global interest rates go up, the interest my dental clinic has to pay goes up simultaneously.
It acts as a built-in hedge for the investor.
It sounds like a win-win on paper. The borrower gets speed, and the investor gets yield and rate protection.
It does.
But there is a psychological element here that drove the explosion of this market. And it brings up a classic analogy in finance, the duck in the pond.
The illusion of stability. It is perhaps the most powerful marketing tool private credit possesses.
Explain the duck on the pond.
Well, these loans are not traded on a public exchange every second of the day. They are held in closed-end funds or vehicles called business development companies, known as BDCs.
Because they are publicly traded, they don't have a ticker symbol bouncing from green to red on your phone screen all day.
Exactly. If you are an investor looking at your quarterly statement from a private credit fund, the surface of the pond looks pristine.
The stated value of your investment appears incredibly smooth and stable quarter after quarter.
It's just a duck gliding effortlessly across the glass-like water, but underneath the surface, out of view.
The fund managers are paddling furiously.
Paddling furiously?
But let me challenge that stability for a second. If my dental clinic hits a rough patch, say a new competitor opens up across the street, and revenues drop 20%, and I realize I might miss my next interest payment. In the public bond market, investors would panic.
The price of your public bonds would crash immediately. Everyone would see the distress.
Right. So how does the duck stay gliding in private credit?
Because the private credit manager controls the valuation process. They don't have to rely on a public market clearing price.
So what do?
Instead, the manager just quietly sits down with you behind those closed doors.
Yeah.
They renegotiate the covenants of the loan.
So they just changed the rule.
Exactly.
Yeah.
Maybe they extend the maturity date by 2 years or slightly alter the payment terms. Then they turn around and tell their investors that the loan is fine and they've just restructured the timeline.
Wow.
They effectively mask the true real-world volatility of the underlying business because they control the narrative and the pricing models.
And this is where the blind spot becomes systemic. If the entire architecture is based on closed-door trust, on managers effectively pinky swearing that their internal spreadsheets and proprietary valuation models are accurate, aren't we just opening the door to massive blind spots?
It is a huge vulnerability.
Right. I mean, how long can you pretend the duck is just gliding when the current in the water starts getting violent?
And that is the defining theme of the August 2026 data we are analyzing today. The current in the water is getting violent, and we are no longer relying on trust.
The hard numbers are finally starting to leak out of those closed doors and into the public domain.
The duck is officially thrashing in the water.
Let's dive into those hard numbers, because this brings us to the new cracks in the foundation. The data from Fitch Ratings and the Wall Street Journal reveals a sudden surge in defaults and rapidly growing internal watch lists.
And a heavily utilized mechanism known as PIK.
Yes, let's start with the default data because the numbers are stark.
According to the latest comprehensive reporting from Fitch Ratings, the private credit default rate hit a record 6% through the second quarter of 2026.
6%. For an industry that built its entire reputation on the idea of pristine, highly controlled underwriting, a 6% default rate is a massive psychological and financial blow.
It is. And this isn't just isolated to small, fringe players taking wild risks either.
No, the Wall Street Journal analysis specifically looked at the massive publicly traded vehicles overseen by the absolute titans of the alternative asset industry.
Firms like Ayers and Blackstone and Golub Capital.
Exactly. And the journal's findings confirmed that non-performing loans at these top-tier funds have hit 5-year highs.
We're talking about aggregate stress levels that now exceed the pain we saw during the incredibly aggressive Federal Reserve rate hiking cycle back in 2023.
Even Blue Owl, which is considered one of the premier direct lenders in this space, saw the default rate on its flagship fund jump to 2.8% in the second quarter.
But reading the quotes from the top executives in these reports creates massive cognitive dissonance.
It really does. The data says non-performing loans are at multi-year highs, but the executives are projecting an aura of total unbothered calm.
Take David Golub, the co-CEO of Golub Capital. He admits they're in a, quote, credit cycle, which is finance speak for a rough patch.
Right.
But he completely dismisses the idea that there is any systemic danger or a sky is falling narrative. He just says it's a normal environment where you'll see some winners and some losers.
Yeah, and you see a very similar stance from Mark Lipschultz, the co-CEO of Blue Owl.
Yes, on their recent earnings call, he insisted that across their direct lending strategy, credit health remains incredibly strong.
He went so far as to state that they have seen no meaningful change in our watch list compared with a year ago.
And for you listening, a watch list is essentially a fund's internal purgatory.
It's the list of borrowing companies that are showing signs of financial deterioration, right?
Exactly. They haven't formally defaulted yet, but the fund is monitoring them closely because they are flashing warning signs. It is the leading indicator of future defaults.
And Lipschultz's claim that their watch list hasn't changed makes Blue Owl a bit of an outlier in this data set.
Very much so, because the journal's broader analysis shows that private credit funds managed by Ayers and Golub and KKR all reported tangible increases in the number of borrowers landing on their watch list this year.
In fact, those watch lists are at their highest aggregate levels since the 2022 and 2023 rate hikes.
So we have a clear contradiction here. The macro data shows defaults at 6% and watch lists swelling, while the executives are telling investors there's nothing to see here.
How do we reconcile that? Like, how are the funds mathematically delaying these defaults to keep the surface of the pond looking smooth?
We look at the mechanism they use to buy time, and that brings us to the Boston Fed data and an acronym that is sweeping through the private credit industry right now.
PIK.
PIK, which stands for payment in kind.
Break down the mechanics of a payment in kind loan for us, because when you look closely at how this works, it feels like the ultimate sleight of hand.
It is an incredibly powerful but incredibly dangerous restructuring tool. Under a normal loan agreement, the borrower must pay their interest expense in hard cash every single month or every quarter.
Right, that's standard.
But in a payment-in-kind arrangement, if a borrower is struggling, maybe their revenues dropped or the floating interest rate went so high, they simply don't have the cash flow to cover the monthly payment, the private credit lender offers them a lifeline.
What's the lifeline?
The lender allows the borrower to simply take that unpaid cash interest and tack it onto the total principal balance of the loan.
Let me stop you there because I want to map this to an everyday scenario.
Go for it.
Essentially, a PIK loan is like letting me pay this month's credit card bill using a brand new credit card.
That is a remarkably accurate way to conceptualize the math.
So I haven't technically defaulted today. The bank hasn't charged me a late fee, and they don't have to report a delinquent loan to the credit bureaus.
So on paper, everything looks fine.
But I haven't actually paid a single cent. I have just compounded the debt mountain for tomorrow. Next quarter, my total debt is higher, and the interest will be calculated on that new, larger principal.
Exactly. And From the perspective of the private credit fund manager, it is a brilliant accounting maneuver
How so?
because the lender gets to record that unpaid rolled over interest as accrued income on their balance sheet. Their financial statements show that they are still generating yield even though absolutely zero actual cash changed hands.
It keeps the fund's returns looking healthy for their investors.
Right. But the new research from the Boston Fed reveals a deeply concerning acceleration of this tactic.
What did the Boston Fed find?
They found that the share of business development company loans structured as PIK surged from 5.4% in early 2022 to a staggering 9.8% in 2026.
Nearly 10% of these loans are now paying interest with more debt.
Yeah, it's wild.
That is an enormous portion of a $2 trillion market actively engaging in what looks like a desperate stalling tactic.
And as the Boston Fed researcher noted in the report, a sudden reliance on PIK is a glaring, undeniable sign of stress. It is the ultimate extend and pretend mechanism.
Extend and pretend.
You extend the runway and pretend the company will eventually generate enough cash to pay down a debt burden that is now significantly larger than when they started.
And the danger of this tactic multiplies
Yeah.
when you analyze exactly which sectors these funds have been aggressively lending to.
Yes.
This connects to a massive macroeconomic shift happening in the technology sector right now, specifically regarding artificial intelligence. The private credit industry has a massive exposure to software, don't they?
A massive exposure. During the boom years of the 2010s and early 2020s, private credit lenders fell absolutely in love with software companies, specifically SaaS, software as a service.
Oh, wow.
According to data, roughly 15% of all BDC loans are heavily exposed to SaaS companies.
And the logic behind that love affair made sense at the time.
Yeah.
Software companies operate on subscription models.
Right, recurring revenue.
If a mid-sized logistics company signs a 3-year contract for your enterprise inventory software, you have locked in highly predictable revenue.
And as a lender, predictable revenue is the holy grail. You can easily underwrite a large loan against those future subscription payments.
Precisely. The entire underwriting thesis for those loans rested on the assumption that these SaaS companies possessed deep economic moats.
Lenders assumed that they had total pricing power and incredibly high customer retention rates because switching enterprise software was traditionally a nightmare for businesses.
But generative AI is rapidly dismantling those assumptions.
It really is.
How does AI threaten a private credit loan to a software company?
Because AI fundamentally lowers the barrier to entry for software development. Generative AI models are making it vastly cheaper and faster to write code.
So that enterprise inventory software company, which thought its market position was unassailable, is suddenly facing competition from a lean startup.
A startup that used AI to build a comparable product at a fraction of the cost.
Right. And if the startup offers a cheaper AI-built alternative, the established SaaS company loses its pricing power. They can't force their customers to accept a 10% price increase upon renewal.
Exactly. And if your pricing power collapses, your margins shrink. If your margins shrink, your cash flow evaporates.
Suddenly, that highly predictable recurring revenue isn't enough to cover the massive floating rate interest payments you owe to the private credit fund.
So the software company goes back to the lender and asks for a PI arrangement. They add the interest to the principal.
But here's the fatal flaw in that strategy. A PI loan assumes the borrower just needs time to recover.
Right.
But if the AI disruption isn't a temporary cyclical dip, if it is a permanent structural destruction of their business model, they are never going to generate the cash to pay off that larger debt mountain.
You are just delaying the inevitable. Those PI loans will mathematically have to turn into actual hard defaults.
Which means the internal pressure inside these private credit funds is building exponentially. The corporate borrowers are stressed, defaults are climbing to 6%, and a tenth of the market is kicking the can down the road with more debt.
That covers the internal pressure perfectly. But this market isn't operating in a vacuum. There is a massive external pressure cooker developing at the exact same time.
Right, because the people who supplied the capital to these funds are reading the exact same data we are, and they're starting to demand their money back.
Let's shift our focus to how these funds are managing the sudden rush for the exits, because the structural design of this market is currently being subjected to an unprecedented stress test.
To understand this stress test, we have to look at how the investor base of private credit has shifted over the last 5 years.
Historically, as we discussed, this was an institutional game. Pension funds lock their capital up for 10 years. They don't panic and demand cash on a Tuesday.
But the alternative asset managers wanted to grow faster, so they pushed aggressively to sell private credit to everyday retail investors.
And when we say retail, we aren't necessarily talking about someone with $500 in a Robinhood account.
No, we are talking about affluent individuals, dentists, successful small business owners, high net worth retirees.
Yes, the mass affluent market. And it worked brilliantly as a sales pitch. According to the data, retail investors have poured roughly $654 billion into these 40-act private credit assets.
Which includes the massive non-traded BDCs.
Exactly.
But retail investors, no matter how affluent, behave very differently than a locked-up pension fund. They read the headlines about 6% defaults and AI disruption. They see the Federal Reserve keeping rates high, and they get spooked.
And the data shows that redemption requests, investors asking the funds to give them their cash back, are surging.
The numbers are escalating quickly. In the first quarter of 2026, redemption requests across the top 10 non-traded BDCs hit an average of 13% of their total assets.
And by the second quarter, that average climbed to 14%.
14% of the investor base wants to cash out immediately, but they can't.
They absolutely cannot.
To visualize why they can't, let's bring back an analogy that perfectly captures the structural trap of a retail BDC.
Okay.
Imagine a massive, luxurious skyscraper. There are 10,000 people inside enjoying the party. But at the ground floor, there isn't a massive lobby with huge double doors. There's only a single standard-size revolving door.
That revolving door represents the redemption gates.
Right when you sign the paperwork to invest in one of these non-traded BDCs buried in the fine print is a structural bottleneck. These funds explicitly state that they will only allow a maximum of 5% of their total shares to be redeemed per quarter.
The 5% gate is a defense mechanism built into the architecture. The fund managers know that the underlying assets, the loans to the dental clinics and the software companies, are highly illiquid.
You can't sell a private loan over the weekend to raise cash.
No. So to prevent a classic bank run, they legally cap the outflows at 5%.
But think about the psychology of that. If 14% of the people in our skyscraper suddenly smell smoke, pull the fire alarm, and run for the exit, but the revolving door only lets 5% of them out the building, doesn't necessarily collapse from a structural failure. But people get crushed at the door.
Panic sets in.
And right now, the managers are actively slamming those gates shut. They are legally trapping the remaining retail investors inside the fund, paying out only a prorated fraction of the cash that the investors actually requested.
So if you ask for $100,000 back, you might only get $30,000 this quarter.
And if you tell a wealthy retiree that they cannot access their own money, the instinctual reaction is to panic even more and submit another redemption request for the following quarter.
Which forces the fund managers into an intense public relations battle. They have to convince the remaining 95% of investors that the fund is fundamentally safe, perfectly stable, and swimming in cash reserves.
Which brings us to some truly brilliant reporting by the Wall Street Journal. Because when you look at how these fund managers are actually attempting to prove their safety, it is a masterclass in aggressive creative accounting.
The journal analyzed how these funds define the concept of liquidity, and the findings are stunning.
Let's get into the specifics of this WSJ data. What did the journal find when they looked under the hood of these liquidity claims?
The primary takeaway is that there is absolutely no standard regulatory definition governing how these non-traded funds must report their liquidity to investors.
So they can just make it up.
Every single fund is essentially making up their own math to project an image of impregnable strength.
Give me an example of the math.
Let's look at Helen, a massive $26 billion private credit fund managed by BlackRock. During the recent quarter, Helen was hit with roughly 13% redemption requests.
So they had to activate the 5% gate and prorate the withdrawals.
Exactly. But in their subsequent shareholder letter designed to calm everyone down, they proudly highlighted that the fund possessed $7.2 billion in liquidity.
Well, if I'm an investor, hearing the fund has $7.2 billion in liquidity sounds incredibly reassuring. It sounds like they have a massive vault full of cash ready to weather any storm.
It is designed to sound exactly like that. But when the journal deconstructed that $7.2 billion figure, the reality was significantly more constrained.
How so?
Out of that massive headline number, the fund only held just over $700 million in actual hard cash.
Wait, really? So where did the rest of the $7.2 billion come from?
A significant chunk of it, $1.6 billion, was composed of what the accounting world calls level 2 assets.
We need to define level 2 assets clearly because categorizing them as immediate liquidity feels incredibly slippery.
To understand level 2, you have to look at the spectrum of how assets are valued. A level 1 asset is something highly liquid, like a share of Apple stock or a treasury bill.
All right, it trades on a public exchange. You can see the exact price every second, and you can sell it for hard cash instantly.
Exactly. And a level 3 asset is at the other extreme. It is completely illiquid and opaque, like a private loan to your dental clinic. There is no market price. The value is entirely based on the manager's internal models.
So level 2 sits somewhere in the gray area between Apple stock and a private loan.
Correct. A level 2 asset lacks a quoted price in an active, heavily traded market, but you can theoretically derive its value based on observable inputs.
Like the pricing of similar assets or benchmark interest rate curve.
It might be a broadly syndicated loan or a certain type of corporate bond.
But the operative word there is theoretically. Theoretically, valuing an asset on a spreadsheet is very different than actually finding a buyer who will give you cash for it during a market panic.
Precisely. And BlackRock's own legal filings acknowledge this risk. They explicitly caution that converting level 2 assets into actual cash can take significant time.
And more importantly, the valuations may have to be adjusted significantly downward to reflect illiquidity, especially if the broader market is under stress.
So to bundle those level 2 assets into a headline liquidity figure as if they are immediately available cash is a very aggressive interpretation.
And it gets even more convoluted, doesn't it?
Yeah.
Because the cash and the level 2 assets still don't add up to $7.2 billion. What was the remaining bulk of that number?
The vast majority of it, $4.9 billion, was categorized simply as debt capacity.
Debt capacity, meaning unused credit lines from other banks.
Yes. But the journal's investigation found a massive caveat. Out of that $4.9 billion in theoretical debt capacity, only $3.4 billion of it was actually immediately available for the fund to borrow.
Why couldn't they access the rest?
Because the Wall Street banks that provide those massive credit lines to the private credit funds aren't stupid. They build strict borrowing formulas into the contracts.
So a fund can only draw down cash from that credit line based on the ongoing health and valuation of their underlying loan portfolio.
The implication being, if the fund's assets run into trouble, say those SaaS software loans start demanding PIK arrangements, or the default rate hits 6%, the value of the collateral drops.
And when the collateral drops, the bank instantly shrinks the amount of cash the fund is allowed to borrow.
Exactly. The borrowing capacity shrinks at the exact moment the fund desperately needs the cash to pay off redeeming retail investors.
This definition game is wild to me. Here's where it gets really interesting. If a fund is counting an unapproved conditional credit line as liquidity, isn't that like me walking into a car dealership, pointing to a Ferrari and telling the salesman, I have $1 million in liquid cash?
Right.
Simply because I own a house, and I technically have the collateral to go ask a bank for $1 million home equity loan. I don't actually have the money. I just have the theoretical capacity to ask for debt.
It is a projection of potential future leverage dressed up as current stability. And what makes this so fascinating is that not every fund is playing the game the same way.
Really? Who is doing it differently?
You look at Blackstone's private credit fund, BCRED, which is an absolute behemoth in the space. They took a much stricter, more conservative path in their reporting.
What did they claim?
They claimed over $15 billion to $17 billion in liquidity, but their internal policy dictates that they strictly count actual cash and immediately available credit lines. They flat out refuse to include level 2 assets in their liquidity math.
So Blackstone is drawing a harder line. But then you swing to the other extreme with Blue Owl.
Yes, look at Blue Owl's OCIC fund. In their reporting, they claimed $12 billion in liquidity. But to hit that number, they included the entire undrawn portion of their credit facilities.
Oh, wow.
They inflated their headline liquidity figure by roughly $3 billion compared to what was actually immediately available to borrow in cash at that exact moment.
How on earth did they justify that to the SEC or to their investors?
Blue Owl defended the math by arguing that they could have easily accessed that extra $3 billion from the banks if they simply decided to post more of their loans as collateral.
Again, relying on a hypothetical future action that hasn't actually been executed.
Yeah, it's a stretch.
It is staggering to think that a retail investor, perhaps a retired dentist who is currently trapped behind a 5% redemption gate, is expected to parse through these wildly varying, aggressively massaged definitions of liquidity just to figure out if their life savings are safe.
It creates a massive asymmetry of information. But this isn't just a case of journalistic skepticism from the Wall Street Journal. There is rigorous academic modeling backing up just how dangerous these structural bottlenecks are.
Right, the academic paper.
Yes, a fascinating research paper by finance professors at Drexel University and the University of Pennsylvania mathematically dismantled the safety assumptions of these funds.
I want to spend some time on this academic paper, because if the math proves the system is fragile, that changes the entire conversation. What exactly did these professors model?
They looked deeply into the mechanics of what economists call procyclicality. They built mathematical models to test whether the internal cash buffers of these retail BDCs, combined with the normal repayments they receive from borrowers, are actually sufficient to handle sustained investor panic.
And what was the conclusion?
The conclusion was definitive. They literally proved that the cash buffers and contractual loan repayments are mathematically insufficient to meet repeated 5% quarterly redemptions. The math simply breaks.
Break down the mechanics of why it breaks. Why isn't a 5% gate enough to protect the fund?
Because of human behavior and market cycles, the professors demonstrated that inflows, the new money coming into the fund from enthusiastic investors, are highly procyclical.
Meaning when the market is booming and returns look quates, new money floods in giving the fund plenty of cash to pay out anyone who wants to leave.
But the moment the market turns, the moment headlines about 6% defaults hit the news, the inflows completely dry up.
So the spigot of new cash turns off at the exact moment the drain opens up with redemption requests.
Exactly. Let's walk through a hypothetical timeline of their model. Imagine a fund enters quarter one with healthy cash buffers. But then, panic starts.
Investors submit redemptions exceeding the 5% cap.
The fund uses its cash buffer to pay that 5%. But remember, they prorated the requests. So the investors who didn't get all their money back immediately queue up again in quarter two.
The backlog of panic compounds.
Yes. By quarter two or quarter three, the fund has completely depleted its cash reserves and exhausted its easily accessible bank credit lines. To meet the ongoing 5% redemptions, the manager is forced to start liquidating assets.
First, they sell the level 2 assets, often at a discount, because they are selling in a distressed market.
And selling assets at a discount reduces the overall value of the fund,
which causes the net asset value to drop.
And when remaining investors see the net asset value dropping, they panic even more, generating a fresh wave of redemption requests.
The professors mathematically proved that the structural design of these funds cannot sustainably survive this cycle without forcing the manager into a severe liquidity squeeze.
It is a vicious cycle.
So if we take a step back and look at the board so far, the corporate borrowers are highly stressed, desperately utilizing PIK to avoid default. The retail investors are panicked, storming the 5% gates and creating a compounding backlog of redemptions. And the fund managers are deploying aggressively massaged math to project an illusion of vast liquidity.
It paints a picture of an industry entirely on the defensive.
And that defensive posture leaves them incredibly vulnerable, because there is a third major player in this ecosystem. While the private credit funds are busy fighting fires internally, the traditional Wall Street banks, the very institutions that private credit was supposed to disrupt and replace after 2008, are not just sitting on the sidelines.
No, they see the weakness and they are swooping in to aggressively reclaim their territory.
It is a textbook example of mean reversion in financial markets. The competitive advantage between private credit and traditional syndicated bank loans has always swung back and forth like a pendulum.
For the last decade, private credit had all the momentum. But right now, driven by macroeconomic forces, that pendulum is swinging violently back toward the Wall Street establishment.
To understand why the borrowers are fleeing back to the banks, we have to look at the macroeconomic environment, specifically the Federal Reserve's stance on interest rates. We are living in a higher-for-longer reality.
That is the catalyst for this entire shift. Remember, the core appeal of private credit for investors was that the loans were floating rate. But for the corporate borrower, that floating rate is a double-edged sword.
When central banks hiked interest rates aggressively to combat inflation, the interest burden on these highly indebted middle-market companies skyrocketed.
Companies are quite literally buckling under the weight of these massive monthly interest payments.
A CFO's primary objective right now is survival. which means cutting borrowing costs by any means necessary.
And right now, the traditional syndicated bank loan market is simply cheaper than private credit.
Just to ensure we are on the same page, what exactly is a syndicated bank loan? Like, how does it differ from a private credit loan?
In private credit, a single fund, or maybe a small club of 2 or 3 funds, holds the entire loan.
Okay.
In a syndicated loan, a major Wall Street bank like JP Morgan or Goldman Sachs acts as the lead arranger. They originate the loan for the borrower, but they don't keep the whole thing on their own balance sheet.
So they slice it up.
They slice it up and syndicate it or sell pieces of it to a massive network of other banks and mutual funds and institutional investors. Because the risk is spread so widely across the public market, they can offer the borrower a significantly lower interest rate.
And the data shows that borrowers are aggressively taking advantage of that lower rate. The recent numbers published by Bloomberg are striking.
They highlight a massive reversal of capital flows. Data compiled by JP Morgan Chase and KBRA DLD tracks the refinancing activity between these two markets.
And currently, companies burdened with expensive private debt are refinancing their loans into the cheaper syndicated bank market, 3 times more often than the reverse scenario.
The ratio is incredibly skewed. Look at the data from the second quarter of 2026. Traditional Wall Street banks successfully refinanced 9 massive corporate deals, pulling a total of $4.5 billion away from the private loan market.
In stark contrast, private lenders only managed to poach 3 deals worth a meager $1.3 billion from the banks.
The banks are winning the tug of war.
To truly grasp the financial stakes of this shift, let's ground this in a real-world example. Let's look at what happened with Catalent, the massive, publicly traded pharmaceutical contract manufacturing giant.
The Catalent refinancing is the perfect case study of this dynamic in action.
Catalent was sitting on an enormous pile of debt, $4.1 billion in private credit loans that had been provided by a consortium led by Ares Management and Blue Owl.
That is a massive, incredibly lucrative chunk of debt for those private funds to hold.
But on a Wednesday, in early August, Catalent executed a ruthless financial maneuver. They completely ditched Ares and Blue Owl. They refinanced that entire $4.1 billion debt load into syndicated bank term loans structured in both dollars and euros.
And by fleeing the private market for the public bank market, Catalent cut their borrowing costs by a staggering 225 basis points.
We should translate that for anyone not steeped in bond math. A basis point is simply 1/100th of a single percentage point.
So 225 basis points translates to 2.25%.
Which might not sound like a life-changing number if we're talking about a car loan, but apply 2.25% to a $4.1 billion mountain of debt.
That interest rate reduction saves Catalent roughly $92 million a year in pure hard cash interest expense.
$92 million of free cash flow simply by changing who holds the debt. You can immediately see why a corporate CFO would gladly abandon the bespoke customization and closed-door privacy of a private credit loan.
When the cost of privacy is nearly $100 million a year, you take the public bank loan every single time.
But let's look at the other side of that transaction. Catalent wins. The Wall Street banks win. But Ares and Blue Owl just lost $4.1 billion worth of high-yielding assets. Why couldn't those private credit titans just match the bank's lower interest rate to keep a massive client like Catalent on their books?
That question cuts to the speculative core of why this current environment is so dangerous for private credit. They want to compete. They want to lower rates to keep their best clients.
But structurally, they are losing the ability to do so because they are suffering from a shrinking pool of deployable capital.
Because of the retail redemptions.
Exactly. It forms a vicious, self-reinforcing cycle. Because retail investors are panicking and demanding their money back from the BDCs, the fund managers have less free cash available to aggressively compete on price.
They need to hoard cash for redemptions, not offer discount loans to retain borrowers.
So they lose their highest quality, most stable borrowers like Catalent to the Wall Street banks.
And who is left in the private credit portfolio? The weaker companies. The SaaS companies battling AI disruption. The companies relying on PI loans to survive.
The overall quality of the private credit portfolio degrades.
And as the portfolio quality drops, the fund managers are eventually forced to acknowledge reality and mark down the valuations of their assets.
which we are already seeing happen in real time. The Blackstone Secured Lending Fund recently had to reduce its net asset value by the largest amount in 6 years.
They are taking tangible hits on their portfolios because they are losing the prime borrowers and keeping the stressed ones.
And the traditional banking sector smells blood in the water. They know the private funds are capital constrained and distracted by retail panic, so the banks are pouncing.
Look at the Federal Reserve's data on bank balance sheets. In the second quarter of 2026, commercial and industrial loans, C&I loans held by traditional banks grew at an annualized rate of 14.2%.
Just a year prior, that growth rate was an anemic 4.4%.
The banks are actively, aggressively exploiting the weakness in the business development companies. Even Barclays credit analysts published a note explicitly stating that the massive net outflows at retail BDCs have provided a golden opportunity for banks to compete much more aggressively.
The empire is striking back.
It really is.
So let's tally up the scorecard for the private credit industry based on everything we've discussed so far. Defaults are hitting a record 6%. Internal watch lists are swelling. Nearly 10% of the market is kicking the can down the road with PIK loans.
Retail investors are trapped in a slow-motion panic behind 5% redemption gates.
The funds are relying on aggressive conditional liquidity math to project stability. And massive corporations are fleeing the system entirely to save tens of millions of dollars with Wall Street banks.
Right.
Logically, looking at that scorecard, the conclusion seems obvious. The private credit industry must be in the midst of a catastrophic implosion. The well must be completely dry.
Right. Wrong. And that assumption leads us to the absolute most fascinating, mind-bending contradiction in all the data we've analyzed today.
Yeah, this is where it gets crazy.
Despite every single structural crack and stress point we just detailed, the money printing press has not stopped.
It hasn't just not stopped. It is operating at full throttle. When you look at the new data provided by Joe A.T. with intelligence regarding industry fundraising, the numbers are genuinely staggering.
In the second quarter of 2026 alone, the private credit industry successfully raised $119 billion in fresh capital.
In a single quarter.
In a single quarter.
If you look at the first half of 2026, in total, they raised an astronomical $190 billion. That represents a 53% increase over the exact same period the previous year.
They managed to raise nearly as much in 6 months as they did in the entirety of 2025.
I have to admit, I stared at these numbers for a long time, trying to process the logic. I mean, how is it mathematically or psychologically possible that a market-facing record defaults an accelerating retail bank run and fierce victorious competition from traditional banks is simultaneously raising $190 billion in fresh capital?
It doesn't make sense on the surface.
Right. Who on earth is looking at this wreckage and deciding to write a $100 million check?
To solve that paradox, we have to look at a brilliant description provided by Scott Nuttall, the CEO of KKR, during their most recent earnings call. He assessed the landscape and declared that the private credit industry is increasingly K-shaped.
K-shaped. We hear that term used in economics occasionally, usually to describe an uneven recovery. It implies the market is violently splitting into two entirely different diverging directions at the exact same time.
Yes. Picture the letter K. The downward pointing line of the K represents the retail side of the market.
The business development companies, the traditional direct lending funds, heavily exposed to floating rate corporate loans, and stressed software companies.
That segment is suffering. The dentists, the affluent retirees, the small business owners, they are trapped in the downward trajectory, begging for their money back and getting gated.
But there is an upward pointing line on the K.
And that upward line represents the institutional side of the market. While the retail investors are trapped in a panic, the massive sophisticated players, the state pension funds, the elite university endowments, the sovereign wealth funds of entire nations are quietly writing the largest checks they have ever written.
But why? Are the managers of these massive pension funds just ignoring the Fitch default data?
Yeah.
Are they blind to the risks of PIK loans and AI disruption? Why are they rushing into a burning building?
Because they aren't rushing into the same rooms that are on fire. They are completely shifting their strategy.
How so?
The institutions are not deploying this $190 billion into the old traditional direct lending funds that focus on corporate cash flow and software multiples. They are executing a massive coordinated pivot into a subsector known as specialty finance and asset-backed lending.
Let's clearly delineate the difference for the listener. What separates a traditional direct corporate loan from asset-backed specialty finance? Why does an institution view one as toxic and the other as a safe haven?
It comes down to what is securing the loan. A traditional direct corporate loan is underwritten based on the overall ongoing cash flow and enterprise value of a business.
If the SaaS company's revenue drops because of AI, their ability to pay the loan drops, the loan is tied to the operational success of the company.
Asset-backed finance is fundamentally different. You are lending against a specific, hard, tangible pool of assets. You aren't lending based on a company's projected future software subscriptions.
You are lending against a portfolio of consumer auto loans or a massive fleet of heavy equipment leases or tangible real estate infrastructure.
The loan is secured by physical or easily liquidated financial assets. If the borrower defaults, the lender seizes the hard assets, sells them, and recovers their capital.
So it is a much more defensive, heavily collateralized posture. You are betting on the value of the physical assets, not the unpredictable cash flow of a corporate borrower facing technological disruption.
Exactly. And the massive institutions absolutely love the defensive nature of it. According to the Meta-Ethics Up, with intelligence data, over $37 billion in specialty finance funds achieved their final closes just in the first half of 2026.
Look at Errors Management, one of the firms facing retail stress. They just successfully closed a fund called Errors Pathfinder III with a record-breaking $8.5 billion in capital commitment.
It is officially the largest asset-backed finance fund ever raised in the history of the industry.
So the titans of alternative asset management are rapidly evolving. They see the iceberg that the retail direct lending ships are hitting, and they are actively steering their massive institutional dreadnoughts in a completely different direction.
You look at KKR. Despite the stress in credit, they recently reported record overall earnings, largely driven by incredibly successful exits in their private equity division. They are using their massive diversified scale to easily weather the storm.
And look closely at the messaging from Blue Owl. While their retail-focused credit funds are navigating surging redemptions and utilizing aggressive liquidity math, their executives are actively pivoting the narrative.
They are loudly touting their real asset business to institutional investors. They are raising billions to invest heavily in digital infrastructure, specifically the massive energy-intensive data centers required to power the artificial intelligence revolution.
They're pivoting away from the software companies being destroyed by AI and pivoting toward the physical infrastructure powering the AI.
They are moving to exactly where the smart institutional money wants to go. What's fascinating here is we are watching a real-time segregation of the market.
It is a ruthless evolution to witness. The retail investor is left holding the bag, absorbing the pain of the floating rate corporate stress, the PI delays, and the illiquidity gates. Meanwhile, the mega institutions are successfully, smoothly pivoting to asset-backed safety and future-proof digital infrastructure.
There is a quote from Mark Lipschultz, the co-CEO of Blue Owl, that perfectly encapsulates this dynamic. When he was asked by analysts about the surging retail redemptions, he casually remarked, "It takes time after a hurricane blows through to clean up."
It is a breathtakingly candid analogy.
It really is.
Because in this scenario, the retail investors are the ones living in the wreckage of the hurricane waiting for the FEMA trailers to arrive. Meanwhile, the institutional investors and the fund managers have already helicoptered out and are busy building the next multi-billion-dollar weatherproof bunker on higher ground.
Which brings us to the crucial question of impact. How does this two-tiered K-shaped reality actually affect the broader economy?
Because if a listener is sitting in traffic right now thinking to themselves, I'm not a billionaire, I don't manage a sovereign wealth fund, and I don't own a chain of dental clinics, why should I care that Ares raised an $8.5 billion asset-backed fund while some wealthy dentists got gated in a BDC?
You should care deeply because the macroeconomic spillover effects of this market segregation are profound. Private credit didn't just grow in a vacuum, it became deeply embedded in the plumbing of the real economy.
If private credit managers are forced into a defensive crouch because of retail redemptions and 6% default rates, the overall supply of credit for middle market businesses shrinks dramatically.
And as we know, middle market businesses are the primary engine of employment and economic growth in the country.
Exactly. If a mid-sized regional logistics company wants to expand their warehouse network to hire 200 new workers, but they can't get a loan because the private credit funds are hoarding cash and the traditional banks are tightening their lending standards, that expansion doesn't happen.
Those 200 jobs are never created. Worse, if a company can't refinance its existing expensive debt because the credit supply has contracted, they might be forced into mass layoffs just to cover their interest payments.
A contraction in the shadow credit supply directly stalls Main Street economic growth.
And beyond the direct employment impact, there is another massive spillover channel that connects directly to the everyday listener, and that involves the life insurance industry.
This is perhaps the most critical structural risk. The risks of private credit are now deeply embedded in the foundational safety net of the American middle class.
According to industry data, U.S. life insurers currently hold roughly $482 billion in private credit investments. That represents approximately 8% of their total managed assets.
We mentioned the concept of duration matching earlier in our research, but let's actually spell out the mechanics of that for a listener who doesn't run an actuarial department at an insurance company. Why do life insurers need private credit?
Duration matching is the absolute holy grail of the insurance business model. If an insurer sells a life insurance policy to a 40-year-old today, the actuarial tables suggest that person is statistically likely to pass away in, say, 30 or 40 years.
That means the insurance company knows with statistical certainty that they will have a massive liability, a $1 million payout due in exactly 3 or 4 decades.
So they take the monthly premiums that the 40-year-old pays and they have to invest them. They need an asset that matures on the exact same long-term timeline, generating enough consistent yield to ensure that the $1 million is sitting there when the liability comes due.
Correct. For a long time, private credit looked like the perfect duration match. It offered high yields and long lockup periods.
But here is the systemic danger. If the underlying loans in those private credit portfolios, the SaaS companies and the dental clinics, start to default at a 6% clip, or if the funds are forced to take massive valuation markdowns on their NAV, it directly impairs the balance sheets of the life insurance companies holding those assets.
If the insurers take massive losses on 8% of their portfolio, it threatens the integrity of the retirement and life insurance safety net that millions of ordinary people rely on.
Which naturally brings the regulatory agencies into the spotlight. And as we always do on this show, we're looking at this debate impartially. We aren't taking political sides on deregulation versus government intervention.
But it is undeniable that there is a massive philosophical war happening in Washington right now regarding how to handle this $2 trillion shadow system.
The regulatory debate is deeply polarized. On one side of the argument, the private credit industry and its academic defenders argue that this system functioned exactly as intended after 2008. They argue that private credit successfully dispersed risk away from the systemically important, heavily interconnected traditional banks.
The shock absorber theory.
Yes. The argument is that if a massive private credit fund makes bad loans and loses billions of dollars, the wealthy institutional investors and affluent retail clients take a financial haircut. It hurts them, but it doesn't trigger a cascading collapse of the global financial system the way the collapse of Lehman Brothers did.
They argue shadow banking actually makes the traditional banking system safer.
I understand that logic. But what is the counter-argument from the regulators?
On the other side, regulatory bodies like the SEC and the Financial Stability Oversight Council, the FSOC, are terrified of the opacity. They look at this market and see classic dangerous shadow banking. And they vehemently reject the idea that the risk has actually been severed from the traditional banks.
They point directly to the massive interconnections that still exist.
Like the warehouse credit lines we discussed earlier.
Exactly. We discussed how traditional banks provide the underlying debt capacity that private funds use to boost their liquidity metrics. The Wall Street Journal reported that major banks have currently extended nearly $300 billion in these warehouse lines to private credit platforms.
So the regulators are arguing that the risk didn't actually leave the traditional banking system. It just went out the back door and snuck back in through a highly complex, opaque warehouse credit line.
If the private funds collapse, the banks are still left holding the bag on $300 billion in defaulted credit lines.
That is the systemic fear. And beyond the systemic math, regulators are acutely sensitive to the political fallout. When a sovereign wealth fund loses $1 billion, it is a spreadsheet error that most voters never hear about.
But when a massive group of affluent retail voters get gated when they realize they cannot access their retirement savings because a fund manager slammed the revolving door shut, it becomes an explosive political nightmare.
Regulators universally despise the concept of gated retail wealth. So what does this all mean for the everyday investor trying to navigate this landscape? Given this incredibly complex web of moving parts, the rising defaults, the trapped retail investors, the institutional flight to asset-backed safety, and the looming regulatory scrutiny, how does a listener actually track this moving forward?
There are 3 critical barometers to watch closely over the next 12 months. First, monitor the BDC discounts to net asset value.
Let's clearly define net asset value, or NAV, so we know exactly what that discount represents.
Think of NAV as the theoretical liquidation value of the fund. If the fund manager took every single loan they made, sold them all today, and paid off any debt, the fund itself owes what remains is the net asset value. You divide that by the number of shares, and you have the NAV per share. It is what the fund says it is worth.
So if the fund reports a NAV of $100 per share, but I look at the public stock market, and that specific BDC is trading at $78 a share.
Then the public market is screaming that they do not believe the fund manager's internal math. A widening discount to NAV means investors firmly believe those underlying loans are severely impaired, regardless of how smooth the manager claims the surface of the pond is.
If those discounts widen further, it signals total market distrust. That makes sense. What is the second indicator?
Pay intense attention to the internal watch lists. If you are listening to the earnings calls of these massive alternative asset managers, ignore the headline default rate.
Because the default rate is a lagging indicator.
Look specifically at the loans added to the watch list. The watch list is the early warning radar. If those lists keep expanding quarter after quarter, a wave of hard defaults is mathematically inevitable.
And the third critical indicator.
Watch the behavior of the traditional Wall Street banks. Specifically monitor what they do with those $300 billion in warehouse credit lines. Are the banks extending them? Or are they starting to pull back, demanding higher interest rates, or requiring the private funds to post significantly more collateral?
If the banks get spooked and start aggressively cutting off those credit lines, the theoretical liquidity squeeze in private credit will instantly transform into an acute systemic cash crisis. Which brings us to the end of our exploration today. Let's briefly distill the massive journey we have taken through this shadow system. Private credit was born out of the regulatory ashes of the 2008 financial crisis, stepping in to fill the void left by heavily regulated traditional banks.
Over a decade of zero interest rates, it grew into a $2 trillion behemoth built fundamentally on the powerful illusion of calm, smoothed-out closed-door valuations.
But as the August 2026 data proves, that era of easy growth is over. The industry is undergoing a violent, painful maturation process.
It is being squeezed simultaneously from three sides by a higher-for-longer interest rate environment that is crushing their corporate borrowers, by aggressive and controversial accounting maneuvers attempting to mask a liquidity crunch, and by a full-blown panic from their retail investor base.
And yet, despite the undeniable pain being inflicted on the retail side, the institutional titans who architected this system are already evolving to survive the storm, pivoting their massive capital ships toward the safety of asset-backed finance and digital infrastructure.
It is the K-shaped reality. We are watching a $2 trillion market violently bifurcate in real time.
Which leaves me with one final, deeply provocative thought for you to mull over as you digest all of this. It is a concept that builds on everything we've analyzed today, particularly the divergence between retail pain and institutional evolution.
It's an important point.
Over the last 5 years, there was an enormous coordinated industry-wide public relations push to democratize private credit. The prevailing narrative fed to the public was that the titans of Wall Street had finally decided to lower the velvet rope.
They wanted to give the little guy, the retail investor, fair access to a piece of the high-yield institutional pie.
It was framed as an egalitarian financial revolution. But looking objectively at the K-shaped divergence unfolding right now, you have to ask yourself a deeply cynical but necessary question. What if that narrative was never true?
What if the retail investor was simply utilized as a vast temporary liquidity bridge?
Exactly. A massive pool of naive capital tapped specifically to help these alternative asset managers fund their own strategic transition. The titans needed fresh cash to pivot away from risky floating-rate corporate loans and move into the safety of digital infrastructure and specialty finance.
And now that the transition has been funded, the retail gates are slammed firmly shut.
The retail investors are trapped in the wreckage of the hurricane, absorbing the defaults and the illiquidity, while the titans casually move on to their next grand institutional frontier.
If we connect this dynamic to the broader history of financial markets, it suggests a sobering reality. The democratization of finance is often just a very polite, highly marketable term for the transfer of systemic risk.
Thank you for joining us on this deep dive into the hidden mechanics of global finance. Keep questioning the surface-level stability of the financial world around you. If the pond looks a little too pristine and smooth, remember to ask yourself who is paddling furiously underneath. We will catch you on the next deep dive.